Texas. And so tonight we're going to delve into a topic that is incredibly important for most Americans, and that's Social Security income, which is the cornerstone of retirement planning for millions, but is yet oftentimes misunderstood. Social Security isn't just about retirement. It also provides crucial benefits for disabled workers and survivors. And understanding how it works is vital for planning your financial future. There we go. Social Security, as I just pointed out, let me move on here. Here we go. Social Security income. Again, here's a graph here. And so we're going to start here with the fundamentals of basically how Social Security got started. It was established in 1935 as part of President Franklin Roosevelt's New Deal. It was primarily to provide a safety net for workers during the Great Depression. It was designed as a pay-as-you-go system, meaning that current workers' contributions primarily funded current retirees' benefits. So it's not a personal savings account, but rather it is established as a social insurance program. Contributions are collected through payroll taxes, often referred to as FICA taxes, Federal Insurance Contribution Act, which was established to collect these taxes. So employees and employers each would pay 6.2% on earnings up to a certain annual limit, and which is considered the taxable maximum. And then another 1.45% for Medicare, for a total of 7.65% from each party. These funds are then used to pay benefits to retirees, disabled individuals, and survivors of deceased workers. It serves as a vital source of income, especially for lower and middle income individuals, and often represent a significant portion of their retirement income. So who is eligible for Social Security? To be eligible for Social Security retirement benefits, you need to accumulate work credits. And these credits are based on your earnings. In 2024, you earn one credit for each $1,730 of earnings, up to a maximum of 4 credits per year. This amount typically adjusts annually for inflations. Most people need 40 credits or 10 years of work to be eligible for retirement benefits. So this means that you need to have worked and paid Social Security taxes for at least 10 years over your lifetime. It's important to note that these 40 credits don't have to be consecutive. You can work for a few years, you can take a break, and then you can return back to work, and all your credits will still count. And even if you don't have 40 credits, you might still be eligible for other types of Social Security benefits, such as spousal or survivor benefits, which we're going to discuss here lately in just a few minutes here. So how are Social Security benefits calculated? Your Social Security benefits amount is calculated based on what is a concept called the average indexed monthly earning, or the AIME. And this is a crucial concept. The Social Security Administration takes your highest 35 years, they adjust them for changes in average wages over time. And this is called indexing. And then it calculates an average monthly amount. And if you have less than 35 years of earning, the missing years are counted as 0, which can lower your average. And once your average index monthly earning is determined, it runs through a progressive formula. Excuse me, to determine your primary insurance amount, which is your benefits. And this is the amount that you would earn or you would receive at your full retirement age. And we'll cover that in just a little bit. So So you can check your earnings records and get an estimate of your future benefits by creating an account on Social Security Administration website, ssa.gov. And I will encourage you to do that. Go to the Social Security Administration website. You can set up a profile for yourself, and you probably want to speak with someone as well. I want to recommend that highly. So, so when do you claim your benefits? And here's a timeline showing from age 62, showing your full retirement age, and then it shows age 70, which benefit and with benefits percentage increasing over time. And so this is one of the most crucial decisions that you're going to make regarding your Social Security, and that is when to claim your benefits. Your full retirement age is the age at which you are entitled to 100% of your primary insurance amount, which is your benefits. But for those that's born in 1960 or later, your full retirement age is age 67. So it varies for those who are born early. You can start receiving benefits as early as 62, but your benefits, as you can see here, will be permanently reduced. For example, claiming benefits at 62 could mean a reduction of up to 30% of your benefits. Conversely here, you can delay claiming benefits past your full retirement age up to age 70. But for each year that you delay past your full retirement age, the benefit amount increases by a certain percentage known as delayed retirement credits. This credit is 8% per year for those born in 1943 or later. So claiming at age 70 would mean that you would receive 124 up to 132% of benefits, and that's depending on your full retirement age. So the decision of when to claim depends on many factors: your health, your financial needs, other retirement income sources, and whether you plan to continue working. So it's a complex decision that often benefits from careful thinking and planning, and sometimes with the help of a financial advisor. So spousal and survivor benefits. So Social Security isn't just for individual workers. It also provides crucial benefits for spouses and survivors. Spousal benefits: if you're married, you may be eligible to receive benefits based on your spouse's work record, even if you haven't worked or haven't worked enough to qualify on your own. A spouse can receive up to 50% of their partner's benefits. And to claim spousal benefits, your spouse must have already filed for their own benefits, and you must be at least 62 or any age if you are caring for a child under 16 or they're disabled. Survivor benefits: if a worker dies, their surviving spouse, each child, or even dependent parent may be eligible for benefits. And I'm going to repeat that. I said that if a worker dies, their surviving spouse, their children, or even dependent parents may be eligible for benefits. A surviving spouse can receive up to 100% of a deceased worker's benefit if they place a claim at their own full retirement age, or reduced amount if claimed earlier. Now, there are also benefits for surviving children under age 18 or 19 that are still in high school, or disabled children of any age. And because these benefits provide such a vital safety net for so many families when a primary earner passes away or becomes disabled. So this is taxation of Social Security benefits. So here's a tax. It's important to be aware that Social Security benefits may be subject to federal income tax. The amount of the benefits that is taxable depends on provisional income, which is calculated as your adjusted gross income, plus any tax-exempt interest, plus 1/2 of your Social Security benefits. So if your provisional income is between $25,000 and $34,000 for an individual, and $32,000 to $44,000 for a married couple, up to 50% of the benefits may be taxable. Now, if your provisional income exceeds $34,000, or for a single, or $44,000 if married, up to 85% may be taxable. So some states also have may have have tax on the Social Security benefits. So it's essential to check your state's specific rules. This is an important consideration for retirement planning and tax management. So here's a graph showing the projected Social Security solvency or balance scale. So there's no discussion you can have about Social Security, nor would it be complete without addressing its long-term financial outlook. There's a lot of discussion about whether or not Social Security is going to be around in the future. And it's been a subject that I've heard from the beginning of time. But there's a lot of things that has to take place. The system faces demographic challenges. People are living longer. Birth rates have declined, meaning there are less and less workers contributing per retiree. So according to the latest report, one of the latest reports rather, Social Security can pay 100% of promised benefits as estimated from the report up through the mid-2030s. After that, if no legislative changes are made, well, it would be able to pay about 75 to 80% of promised benefits from ongoing tax revenues. So it's crucial to understand that Social Security, in many estimates, based on many studies, based on many reports, is not going bankrupt. It will continue to pay benefits, but maybe without some type of adjustments. It may be able to pay 100% of scheduled benefits in the long term. It may not be able to pay 100% of the benefits in long term. So between 70 to 80% is what the projected changes will be looking at somewhere around the mid-2030s based upon reports and studies. So potential solutions include raising the full retirement age, increasing the payroll tax rate, adjusting the taxable maximum earnings limit, or modifying the benefits formula. And it's a number of ways that they calculate the benefit of Social Security income. They have many formulas that they work. And so there is a very complex political decision that's going to have to be made regarding Social Security income. So while changes are likely, Social Security will remain a vital component of retirement security. So I advise you to, through the adjustments, when you're doing your long-term financial planning, to continue to contact or to reach out to Social Security, set up a profile if you haven't already done so, and let them address some of the questions that you may have. So let's take a look at some takeaways before we wrap this up. So to summarize, here are a few key takeaways. It's a social insurance program. Social Security benefits or Social Security income is a social insurance program that's funded by payroll taxes, providing benefits for retirees, for disabled workers, and survivors. Eligibility requires earning work credits, typically 40 credit hours, equivalent of 10 years of work. Your benefits amount is based on your highest 35 years of indexed earnings. When you claim benefits, significantly impacts your monthly payment. Delaying past your full retirement age can substantially increase your benefit. I want to read that again or go over that again, so make sure that we cover. You understand what I just said. So when you make your claim, when you claim your benefits early, it significantly impacts your monthly payment. But delaying past your full retirement age can substantially increase your benefits. Spousal and survival benefits often offer crucial financial protection for families. A portion of your benefits may be taxable, depending on your provisional income. And so while challenges exist, Social Security is expected to continue to be a foundational element of retirement income. So I encourage you to visit Social Security Administration or SSA.gov to create your personal account, review your earnings record, and get your personalized benefit estimates. Understanding Social Security is a key step in securing your financial future. So thank you for your time tonight, and I've enjoyed sharing. And thank you for allowing us to share this information with our community, and we're looking forward to seeing you again in the future. Marley, Dr. Hurley,